Our next panel will be hosted by Axel Weber, the chairman of UBS, at the present time with a great career as the chairman, the former chairman of the Bundesbank, a great central banker. And he will be introducing our principal speaker, Randal Quarles. And I will not do that except to note that Randal Quarles was, up until his appointment as vice chair, a very active member of the Bretton Woods Committee, and he participated in the work of the committee for quite some time. So it's something that we are very proud to note. And I assume that both of them are in the wings. Is that true? Well, let's, Axel? Oh, they are miking them up. Good. There we go. Welcome back to the committee.
Well, it's a pleasure being here, and Richard, thanks. We were behind the curtain so we could hear you. Thanks for the kind announcement and the introduction. It's a pleasure being here at this conference, and what we wanted to do, ladies and gentlemen, is to very briefly open up with very small opening statements and then move to a conversation. And I had the pleasure to do this with Randy before at a different occasion, so I'm very much looking forward to the conversation later on. But let me tee it up maybe just by giving a bit of background. Where do we stand? If you look at where the world economy is today, both in terms of global growth, but also in terms of the global regulatory and financial reforms, I'm actually very hopeful that we will be in a better place for the next 2 to 3 years than the one we've been in for a long time. Overall, we see the global economy is still in a broad-based, pretty synchronized and strong upswing, despite some of the weak first quarter results that we're seeing come in the major developed markets, US and Europe. Our base case is an upswing that will continue for the foreseeable future, at least a runway of another 1 to 2 years that is pretty clear in my view, bearing risks. However, having said that, the benign economic forecasts that we see are subject to exceptional high risk and uncertainty, such as a looming dispute over trade, European uncertainties around the Italian elections or Brexit, geopolitical tensions, and in the longer term, the potential adverse consequences of, for example, late cycle US fiscal stimulus or emerging larger twin deficits. Therefore, it's not surprising that when you look at the risk, many of them being on the downside, that you need to be cautious despite the fact that you have a probably good and better than for many years outlook for the economy. But let's move to something that is closer to the round of what we'll discuss, and that is the regulatory reform and the evolving framework for doing business for the financial industry. And when we look what had happened, and in one of my previous capacities, I was one of the people that was around in 2007 in an official sector role when the crisis hit. And if you've seen the financial system and the stress that emanated at the time, it is very clear to everyone that the coordinated overhaul of the global regulatory framework that has been delivered and has delivered very important reform was a necessary set of reforms, and it needed to happen. It has made financial institutions more resilient, it has made markets safer, and it's the right direction of travel. But with every direction of travel, there is a point in time at which you ask whether you just want to continue that journey or whether you should slightly change the direction or the speed of travel. Now that many of the reforms are in place, I think we're at a good point in time to assess what has been achieved so far, to ask ourselves what can be and needs to be done in the future, and from my perspective, there are a number of key questions that I would like to start, and I'm very grateful that Randy Quarles, the Vice Chairman of Federal Reserve, is with us here today, that he's open for a number of questions. He will start with an initial statement, but I'll just put a few of those questions out. How do we ensure a consistent implementation of the agreed reforms, for example, the Basel package that has been agreed in December? How can we deal with any consequences of a reform that are unintended? Because whilst many of the reforms that I just said were necessary and led to a much safer environment, there are side effects, and those side effects should be addressed. How do we address the increasing risk of regulatory fragmentation? We're now at a very challenging point in time where a agreed upon global framework, and in brackets, there was already a lot of discussion about the final compromises, so they're not a bliss point of where everyone wanted to end it. They are true compromises, and people had envisaged quite different set of rules in the end. How do we make sure that that set of compromises is implemented in a consistent fashion across the globe? It clearly needs, from the side of the financial industry, who's very supportive of these endeavors, it clearly needs a very much coordinated international regulatory response. And this is why I think it's very good for us to be here. So before we go to the Q&A, it's my pleasure to ask Randy to make a few opening statements on, you've seen him probably on the record. He's sort of given both a speech and also gave testimony. So many of the issues we're going to talk about, he's already teed up, and you saw it in the press the last 2 days. So maybe just for your benefit, I ask him to tee up a few of the issues he wants to talk about, and then we move to some debate.
I'll be very brief. Thank you for that. On the regulatory front, I think the main sort of framing message that I have is one that I know you have heard me say before, and maybe some others in the audience, but I think is an important way of sort of orienting ourselves at this moment in time with respect to regulation. And that is immediately after the crisis and and not so immediately in the post-crisis period that's now lasted almost a decade, the focus has been on the safety and soundness of the financial sector, and that's appropriately so. And there's been a body of post-crisis regulation that's been put in place that in the core areas of improving the capital in the system and creating a focus on liquidity, both at the firms and in the regulators that had not been there before, and improving the resolvability of firms. In each of those areas, that body of post-crisis regulation and that post-crisis effort has been positive and I think successful. But what hasn't been as high on the priority list is what I think is the equally strong public interest in the efficiency of the financial sector. And at this moment, it's a perfectly appropriate time, given the strength of the economy, given where we are and having just completed the Basel III reforms, the last steps in the Basel III reforms. Therefore, we can basically say that the body of post-crisis regulation is complete, to stand back and now, with the benefit of experience and hindsight, to say, how can we achieve these objectives more efficiently? With an eye towards the efficiency of the financial sector. We'll always be able to improve in any of our endeavors. All of us have worked on many large projects in our lifetimes, and in any such project, you stand back and you say, I can achieve this part of it better. And this element that I thought was going to be so critical turns out to have been utterly irrelevant, and this thing that was basically a side thought turns out to be much more important. And these two measures that I see that they're pulling at cross purposes in ways that I hadn't intended, and adjusting in light of that experience in order to achieve your objectives more effectively and efficiently is sheer responsible regulation, and how I at least see the regulatory reform effort. It's not a question of deregulating. It's not a question of swinging a pendulum back. It's a question of achieving objectives with an eye towards efficiency. And I think that can significantly reduce the burden on the financial sector, but doing it in a way that doesn't impair the achievement of those other objectives of safety and soundness.
Yeah, so let me start by asking there, I saw some of your statements yesterday, and you seem to hint at increasingly looking at a different set of regulations for GSIBs and for global banks, and having a more tiered system and a more differentiated system for less global systemic, say national systemic, or even at the national level, less systemic banks. Is that tiered system something that you see evolving over here in regulation, and what areas is it largely going to cover?
So, so I think that to some extent we have always had that here. To a greater extent than has been the case in Europe, for example, we have applied kind of international standards differentially to our smaller banks versus our larger banks here. I think part of thinking about the efficiency of this system, though, is to be even more tailored, is the sort of term of art that we are using here, in the application of regulation to financial institutions, to ensure that the character of the regulation that we're applying is appropriate to the risk and size and systemic importance of the institution to which it's being applied. And therefore, that's not just a distinction between GSIBs and non-GSIBs, really, but along the continuum of risk and size, I think that we can sort of be more granular in how we apply regulation to all of these institutions.
And that will not just involve capital, that will be liquidity, that will be other forms of regulation that you're implementing.
Yeah, exactly. I mean, on the specific question of liquidity, for example, right now we do have sort of a cliff vesting at about institutions that are, in our system, relatively small, have the same framework of liquidity regulation that's applied to them as is applied to the very largest institutions, and that probably isn't necessary in order to achieve our safety and soundness objectives.
Another sort of point that came up in the last 2 days or in the last week that has been discussed here is that for global SIFIs, sort of capital buffers that they have been holding have largely been, unanimous across the field. People talk about minimum requirements, and in my view, talked about minimum requirements too much, because above that minimum requirements, there are tailored requests for capital buffers, largely coming from stress tests and other scenarios. So how you see that play out in the US, and do you see that system becoming internationally? Because we have a very similar system in Switzerland. Does that system of supplementing stress tests and getting capital answers from basically asking the question, how much capital do you need to be credibly resolvable? Will that be sort of the standard that drives the capital requirement?
Well, I think that would be very sensible if that were to evolve internationally. As you know, just last week, we proposed basically the integration of our sort of kaleidoscopic capital regime. We had 24 different capital ratios, and we proposed integrating them into a single regime that would sort of have minimum capital levels and a stress buffer on top of that. That would be determined pursuant to annual stress tests. And while there are pros and cons to both different types of structures, I do think that is a much simpler, more comprehensible, more workable regime fundamentally. So I think there'd be benefits to seeing that across more jurisdictions.
Systemic risk is a key concern for many of the regulators. And so we talked a lot about banking system and systemic risk. Do you see other pockets of risk or even systemic risk emerge in financial markets outside the core banking system that you're focused on?
So I'd say right now, as we look at risk across the financial sector, not just the banking system, I think that our assessment of financial stability risks right now is that that they're moderate, basically by historical standards. They're kind of in the average range. Asset valuations are obviously pretty high, particularly for some categories of assets, stocks, commercial real estate. But the amount of leverage that those assets are supporting, particularly financial sector leverage, is not particularly high. The system itself is a lot more resilient precisely because we have a lot more capital, a lot more liquidity in the system. So, as we look at what risks are out there across the broader financial sector, and that includes the unregulated part of the financial sector, we're vigilant. It's not that they're low, but we think that the risks are only moderate.
One of the key discussions outside banks, in particular, has been central counterparties. And sort of CCP supervision is one area where in a market-based system, there's a lot of focus on. Do you see other areas where sort of regulation, once it moves beyond the perimeters of banking, will focus on? Asset management, market-based finance, or do you think there is a real good reason why those are regulated differently to the core of the banking system?
So when we're looking at systemic risk, I think that the most fruitful way, then there are devils in the details as to exactly how you accomplish it, but it's less are there types of institutions that we ought to be reaching out and regulating, and more are there activities that we think can create systemic risk that can be accomplished in a variety of different types of institutions, and how can we regulate those activities when we think that they pose systemic issues, in a way that's kind of cross institution. And so in the United States we have the FSOC, which has a process for reaching out, but I think that it should not, if it's thinking about designating something that's not currently regulated as a systemic issue, it's less, is it an asset management institution, is it an insurance company, and really, is it an activity that's posing a systemic issue, and regulating that activity, designating that activity, if you will.
Some of the banks that I talk to, and I see Tim Adams in the audience, and that we talk to at the IF, are really concerned about regulatory fragmentation going forward. Is that a concern you share, or maybe put it slightly differently, do you actively, from the Federal Reserve side, work towards avoiding that fragmentation and discussing with peers in Basel on how to move to a much of a level playing field for the global banks? I mean, that's the area where we're most focused.
Yes, and I think that's very important. I think that the Federal Reserve generally has, but I certainly think that going forward that we need to be engaged in the international fora where these or the rules that will have global applicability are discussed, precisely to ensure that we have a level playing field for our institutions, and other countries have the same interest in participating for their institutions, to ensure that global stability risks that could, risks that could be posed to the United States, that, we also are satisfied with the regulatory regime that's managing those. So I think it's very much in our U.S. national interest to be fully engaged in those fora. And when we have issues with, with particular regulatory proposals, we should discuss them in those fora as opposed to making our purely internal decisions and deciding to deviate from them.
And I would guess most of the central banks and most of the regulators we talk to would be in the same place. The tricky issue is once implementation of these international rules moves to national jurisdictions, you have policymakers involved, and you need to pass laws, and here Congress and the Senate get involved, and what you put into the process might not be what comes out of the process. So how do you ensure a maximum of consistency of that process, and which extends really beyond your own sphere of influence?
Well, it does, but I think that's part of our job as national regulators. I'm not entirely sure how the narrative has developed, which it has developed in the United States, is that we sort of go into these international fora and we lose and end up having to come back with unsatisfactory regulatory proposals that we're expected to implement in the United States. My experience has generally been that when people are unhappy with what the U.S. has brought into the international regulatory fora, with what the U.S. brings out of the international regulatory fora, it's because they're unhappy with what the U.S. took into the international regulatory fora, and that therefore our job domestically is to ensure that we're in continuous communication with the legislature, with stakeholders, with the banks, with the community representatives, to take all of that into the international discussions, and then ensure that we're satisfied with the level playing field that results. And if we do it that way, if we have a very transparent process here, and if we encourage transparency in the processes of these international fora as well, we'll have much greater success in making the case that these are rules that are in our interest, not rules that are being imposed upon us.
And it's interesting, I mean, coming from Switzerland, which is where our home market is, clearly in Switzerland there is the perception that we're rule takers in these international fora, but it's interesting to hear that the United States of America has the same feeling about being a rule taker in these. It's not quite probably how these committees work, and as you say, I remember from my own time on these committees, there is a robust debate amongst the key regulators, and we see it on our colleges, that many of them are actually in a very similar place, because it's very important to have no arbitrage between regulatory entities, and,
right.
and that, I think, really drives these compromise. Since it's a very sort of differentiated crowd of different interests, let me sort of move from the core of your responsibilities and what we as banks are interested in to a more broader setting, cryptocurrencies.
Yes.
We talked about that in our last conversation. You were very clear sort of how you look at that. Maybe just share your view with the crowd here on how you see that evolve. And at the time when we talked, which was before December, there hasn't been a lot of talk about sort of moving to a more regulatory-based framework for that, but things have been on the move since then. So where does the Fed stand now?
So with respect to cryptocurrencies, I guess we're told. I was told at one point to call them crypto assets, and then they were crypto something else. And so whatever these crypto things are, so right now, as a systemic matter, they don't pose particular issues, right? I mean, they are not deeply integrated into the payment system. Despite all the press that's associated with them, they aren't particularly large enough to have macro effects in the financial sector or in the economy. Clearly, serious issues about consumer protection, given the speculative valuations that are assigned to a lot of them. Very serious issues about the financing of criminal activity, that are important to governments, and but of financial stability risk, they don't really pose one. Now, as you said, it's a rapidly evolving, rapidly moving area, and so we're monitoring it closely. But right now, our principal concern would be to find ways to address those consumer protection and criminal financing risks. And we don't have a particularly good regulatory structure in this country for addressing those risks for cryptocurrencies. It's not perfectly clear that they count as securities for the SEC to regulate them. There are a couple of futures contracts on them now, which gives the CFTC a certain hook on regulating them, at least from consumer protection, but a limited hook. There are questions as to exactly how you regulate the underlying spot market. Since they don't pose a particular, they aren't a particularly important part of the payment system, our rules and so forth govern the payment system, don't really create a hook. So, we are wrestling with how to address what we see as the concerns, given our existing regulatory framework, and I think that most of the countries of the world are. They have similar issues.
And, in addition to all the weaknesses you outlined, every time I'm on a panel with the Secretary of the Treasury, he reminds all the banks in the room that as far as cryptocurrencies are concerned, AML, KYC obligations are the same as for any engagement with a counterparty. And so what is reassuring is actually when I read sort of across the headlines over the recent months, there are new forms of digital currencies emerging that are just addressing all these weaknesses and that try and set themselves aside from these initial offerings by basically filling some of the voids or solving some of the problems that were associated. And that's financial innovation, I think, in a positive sense.
With respect to the idea of cryptocurrencies, kind of non-government supported currencies, I do think that, tulips are still with us, right? I mean, they're beautiful flowers. They still have value, and maybe at the time that we get to the other side of the bubble, there will be some enduring value, to be developed from this type of an asset.
And fintech, sort of in a more broader setting, just not focusing on digital or cryptocurrencies, there's quite a differentiated approach among major jurisdictions towards fintechs and startups. Singapore, one of the early nations that with Sandbox enabled some of these developments. Switzerland, where we're based, very strong drive towards attracting fintech. Where do you see them in terms of regulation? Too small to matter some time ago, too large to ignore now, or do you still see that as a sort of grassroots development that can largely continue to be unregulated?
So, with respect to fintech, at least in the United States, I don't view it as completely unregulated because most of the various fintech companies that have sprouted up, they are interfaces in one way or another to the existing banking system, right? They improve the consumer interface, in various ways, but at one point they either for funding capacity or for connection to the payment system, they are backed by a bank for the most part, not always, but for the most part. And through that connection, we do have regulatory insight into what's happening there. We have the ability to, in many cases, to look directly at the activities of those companies, and other parts of our regulatory apparatus have even more direct capacity to regulate them. So they aren't completely unregulated. I do think, again, that part of our obligation as regulators is to not only allow but encourage the development of innovation, particularly what looks to be consumer-friendly innovation. So I'm not sure that our existing structure may be just about right for that.
Right. And we see that everywhere. I mean, we in the financial industry are seeing fintechs become part of our value chain, and so that they're innovating parts where we as large financial institutions have been less innovative. Yeah. And so I think that it's a very well-versed set of enterprises that are developing there. Large TechFin, sort of large companies move into financial services. How do you see that evolve?
So that's a different thing, I think we are at very early stages. We're at very early stages in the actual evolution of that, and so we're at very early stages in how we think about that evolving. But it's certainly conceivable, that evolves in a way that's much different than creating some interface that tacks on to the existing financial infrastructure. And in some significant way disintermediates or reimagines, the connection between counterparties of a sort that's traditionally been performed by financial intermediaries, and so that could raise issues to the extent that is done on a fractional reserve basis, right? And if it's not done on a fractional reserve basis, it's hard to see how it can really then be competitive with the existing financial sector. And if it is done on a fractional reserve basis, it will raise many of the same issues that call for regulation of the financial sector. They will raise many of the same issues. So I think we have to wait and see how that evolves. But I think that is a much bigger issue and will ultimately be a much bigger challenge for regulation than what we currently think of as fintech.
I see Richard and Bill in the first row, and they were very clear with me that I should open for questions. So I will, because that's an old Bretton Woods Committee tradition, so I'll do that right now because I don't want to have this conversation without you having the chance to ask questions. Please identify yourselves who you are. And there's two hands back there, so we start with the microphones right there. The lady.
Hi, Victoria Guida with Politico. I wanted to ask, you mentioned that any entities outside of banking that could potentially pose a systemic risk, it would be because of activities rather than the type of institution. I was just wondering, could you point to any activities in particular that you think would be worth looking at for potentially posing a systemic risk?
So, that's something that would be considered in the FSOC, and I don't want to prejudge those discussions. The FSOC right now, as you know, is in the process of thinking about exactly how one would create the framework for designating an activity as opposed to an institution. And there's more work that needs to be done there. So I won't front run that discussion.
There was another hand. Dino, please.
Thank you. So Dino Coase from CLS Bank. My question is about the yield curve. So we've had this massive flattening of the yield curve from about 250 a while ago to about 40 now. It's heading downwards, it seems like. As you know, before every recession in the last several cycles, whenever we've had a flattening or minor inversion of the curve, we've had a recession follow. So my question is, what are your thoughts about that? And does that suggest that we might be later in the cycle than economic models would suggest?
So, I think when you go back and look at those historical instances, I think a lot of it depends on what's driving the flattening of the yield curve as to whether it's going to, be a reliable signal of a recession. Now, at some point, even a stopped clock is right twice a day, but, and there is still a business cycle. But I think that the flattening of the yield curve we're seeing now is more a result of, kind of expected lags in sort of the adjustment of the longer-term rates once shorter-term rates start to rise. And if that's kind of what's driving things going forward, I don't think it's as likely that the inversion of the yield curve is a reflection of sort of an indicator of a recession to come. So. Obviously it's something that we are looking at, and if you were to have an extended, even if it were not as a signaling factor, if you were to have an inverted yield curve for an extended period of time, right, then that in itself could have effects on the financial sector that that could then lead to sort of a lack of support for real economic activity. But I'm not viewing the current flattening of the yield curve as a particular signal towards impending recession.
There's a question back there.
Having listened, Danny Galino from Mace News, having listened to you yesterday in the testimony, I know you walk a fine line. You have to reassure the Republicans and not disappoint the Democrats too much. But could you just outline what, from your point of view, you think your main departure is from the approach of Governor Tarullo?
Where to begin? So I think that I guess I'd say I don't want to over-characterize what Governor Tarullo's approach would be. Some of the proposals that we have made and will make over the coming months and year, I would not be surprised if he supported, and others he might have reservations about. So I'm not going to delve too deeply into the mind of Dan, but I do think that the emphasis on the public interest in the efficiency of the system is something that has not been a high priority message or of the Federal Reserve or the regulatory system generally over the course of the last decade, post-crisis. And I do think that it's something that going forward will be a lens through which we look at all of both existing regulation and our regulatory proposals going forward. It will be a much larger factor than it has been in the recent past.
And actually, just to chime that, if I may, that is true even outside the US across most of the jurisdictions, because what we've seen in Europe as well was a re-regulation that was largely, first and foremost, looking at safety and soundness. And as that was in place and the side effects that emerged, the efficiency of the system and the financial system to do its intermediary role became right center stage as a result of that first round of regulations. And so I think this is something that you're seeing across jurisdictions, where now the efficiency of the regulation is a lot more in the focus than the regulation itself. There were further questions? Richard. Microphone here.
Thank you. As a result of the crisis, there have been a lot of regulatory changes that have taken place, both legislative and regulatory by the agencies, the Fed in particular, and globally as well. Those that have aimed at prevention of another crisis have been focused upon and dealt with, are being dealt with. That's exactly what we've been talking about now. And I think that conversation is a very healthy one, very fruitful one. I like your idea of focusing on the efficiency of the system, something that has been neglected, there's no doubt about it. And it's not a question of pendulum swinging back and forth between tightness and liberalness, so forth. But there's a whole other problem out there that I see as a result of the crisis, and it's mostly legislation, and it's mostly in the US, not abroad. And that is the constraints that have been placed on the regulatory agencies, the Fed and the FDIC in particular, to deal with an emergency if it should come. And that is not impossible. I mean, all of these other measures, they're great for what they are, but it's not impossible we'll have another crisis. It could come from anywhere, not the least of which could be a major cyber attack on the banking system, and there'd be chaos. The Fed's powers, emergency powers to deal with the crisis, have been limited by the Congress, the FDIC as well. Is that on the agenda? Do people begin to think about that? It's not, I mean, it's a highly unlikely event, but it could happen. And if it does happen, and you, the regulators, can't deal with it with the tools you have, and they've been cut back from what they have been for many decades, there would really be a problem. And I know this can't be a first priority in the agenda of the legislators, but is it something that the Fed has got on its agenda, long-term agenda?
So, history would tell us that we will, in fact, likely at some point, we will not know the date of its coming, but we will likely have another crisis at some point. So how we respond to a crisis, given the tools that we have, is something that we do think about a lot, and think about with other regulators, both within the United States and internationally as well. So we have given a lot of thought as to how we can respond. We have tabletop exercises where we work out, okay, given the tools that we have. I would say that while the response toolkit of the regulators has been changed, we aren't without tools, and part of the reason for these exercises is to determine exactly how to use the tools that we have. So, so I would not be, I wouldn't be too negative about our ability to respond in the future. What we have to do is sort of ensure that the tools that we have, that we know how to use them. We're kind of, we know where the hammer is in order to break the glass, should that become necessary. And we do engage in those sorts of exercises all the time.
I think we can take one or two more questions, please.
Thank you. Rich Miller from Bloomberg. What are the implications of the drive to make the financial industry more efficient and to significantly reduce the burden on the financial sector for monetary policy?
Well, at one level, that's a very simple question, and at another level, that's an incredibly complex question. So I'll give the simple answer. I think that to the extent that that we have an efficiently functioning financial sector, that we actually improve our ability to pass through monetary policy. I also think that the reverse is true. As we normalize monetary policy, I think that actually helps the efficient functioning of the financial sector, particularly our smallest banks that are most sensitive to the level of interest rates and to the slope of the yield curve. Ultimately, our policy normalization will create a better environment for their operation, and then on the flip side, an efficient regulatory sector and an efficient regulatory system and a healthy financial sector creates a more efficient transmission mechanism for monetary policy. So we view them as basically mutually supportive. And then at some time we can get into a much more complex question, overly granular for this forum, about the relationship of liquidity regulation and balance sheet normalization and all of that.
One last question over there, please.
Hi, John Heltman with American Banker. You touched on this a little bit in your testimony yesterday about the granting of charters, ILC charters. I wondered if you could say whether you, why wouldn't you grant an ILC charter? What kind of an ILC charter might you object to, and what might be the nature of those? And a sort of related question, going back to the now former acting controller, Noreika, gave a speech regarding the barrier between commercial and financial systems. Is that something you think about? Do you think that those barriers might be something that should be reconsidered more generally?
So on the ILCs, I would look at the granting of an ILC charter. I think we should apply the same, the same measures of assessment that we apply to the granting of a charter of any other financial institution, and the safety and soundness of the business model and the confidence in the management and all the assessments that would generally go into that. I don't view them as a particularly special or excessively problematic case. There are certain specific issues to them, but the basic granting of a charter should be the same. On the larger question of banking and commerce, I thought that former acting controller Noreika, that's quite a mouthful, Keith's speech was, I thought that it was quite interesting. I haven't given a lot of thought as to two proposals along those lines because I don't think that they're currently politically practicable. But I thought his speech was quite interesting.
One of the expectations of bringing a German-Swiss banker on here is to end on time. And I'll do that here. And let me, on all of your behalf, thank Vice Chairman Randy Quarles for giving us some insight into the Fed's group. I understand from Richard that there will be drinks afterwards, so I don't want to stand between you and drinks. And Richard, with that, we pass back to you.
Oh, that's my message. Thank you so much. That was great.
Thank you.
And there will be drinks. There will be a reception now, beginning now. And all of us at the committee want to thank our speakers of this particularly scintillating discussion. It was. And also to thank the UBS, if I may, thank the chairman here in person for helped to sponsor, and of course our friends from SICPA who have been so faithful a sponsor over the years. Thank you all for coming, and we look forward to talking again and again, between now and the 75th anniversary of the Bretton Woods Conference. So let's go have a drink. Thank you.
Very good.